Hi, my name is James Shepard, and in this little mini-series, I'm going to be talking to you about understanding compensation in the payments industry. In other words, how do we make money in the payments industry? Now, in this first video, I want to cover some common industry terms. So for those of you that have been around the industry for over a decade, probably most of these are going to be a refresher for you, but it's very important that we understand what these terms mean before I dive into all the details of how to make money and how all of that works. So first of all, let's understand the core, the big picture is we have revenue and expenses. So anytime we're talking about how do we make a profit in any business, what we're ultimately talking about is revenue and expenses. Well, in the payments industry, specifically for ISOs and companies like that, well, what that means is fees minus cost, right? So we have the fees that are collected. So let's imagine we have a merchant, just to make the math easy. Let's say we have a merchant, it's a restaurant, they do $100,000 a month in card processing volume. So they run $100,000 a month in transactions. And let's say that they are paying $2,500 a month in fees. That would mean they have an effective rate of 2.5%, which I'll get to in a second. So $2,500 in fees that are collected from that merchant, that is the revenue on that account for the ISO, right, or for the processor. So that's the revenue. Well, what are the costs? So that's what we have to break down. So the first term I want to make you familiar with is the term I already used, and it's called the effective rate. Now, the effective rate is very simply going to be total fees divided by total processing volume. So in the case I mentioned a second ago, we have a merchant that does $100,000 a month in processing volume, and they pay $2,500 a month in fees. Well, if we take $2,500 divided by $100,000, that is 2.5%. So that is their effective rate. Now, you're going to see effective rates go all over the place. I have seen businesses where they have a larger average ticket size, but they take a lot of debit transactions. These could be like auto repair shops. I've seen them where they have an effective rate of less than 1.5%. I've seen a statement, 1.1, 1.2%. That's their effective rate. That's the total amount that they pay for processing, right? On the higher end, we have maybe some of the differential pricing models like dual pricing or surcharging, where the effective rate might be 3 to 4%. On the extreme, we see high risk accounts, which we're going to talk about in this little mini series as well, where they're paying 6, 7, or even 8% effective rate on that processing. So the first term is the effective rate. So now that we understand this bigger picture, we have revenue and we have expenses, or we have fees collected and we have cost, right? And we understand that when you put those numbers of fees divided by total volume, we get the effective rate. We now need to break down the cost, right? So what kind of costs are there? Well, in this industry, we think of the cost in terms of the Schedule A. Now, I don't know who came up with the term Schedule A. Maybe you can comment below this video if you know who came up with that. I have no idea. Seems like kind of an arbitrary name to me, but the Schedule A in this industry, we're talking about this concept of what are the costs on an account. Now, everybody has a few core costs that they pay. These would be things like the interchange cost, right? So the cost of interchange. Well, interchange is the cost of processing a transaction. It's collected by the issuing bank, the bank that issued the card. And this is going to range in the US market. It's going to be an average of around 2.1%, somewhere in that range right now in the US market. So again, let's use our example for a minute. Let's say we have a restaurant, $100,000 a month in processing, and we're collecting $2,500 a month in fees, so that's our revenue. And then let's say that on that the interchange cost is 2.1%. Well, that's $2,100 a month. So that takes $2,500 minus $2,100 in interchange cost. The second big cost is going to be your card brand fees and assessments. So the assessment would also apply to things like American Express, but with Visa, MasterCard, Discover, they all have card brand fees. Even the PIN debit networks have card brand fees. These are just different assessments, and they're smaller costs. I have found that they tend to equate to around 0.2%. So again, in this case, that would be 0.2% of 100,000 would be a couple $100. Okay, so now we have $2,100 in interchange cost. We have another $200 in card brand fees. Add that together, we have $2,300 in cost, and we charge $2,500 in total fees. So that leaves us with $200 left over. Well, what are the other costs that have to be taken out before we can even start to talk about how much money we're going to make? Well, that's where the Schedule A comes in. So the Schedule A will say you're going to have these pass-through costs. Well, the pass-through cost is the interchange and the card brand fees. But then it's also going to say that there's other costs. Okay? Now, these costs are going to be split up into mainly 3 categories. Number 1 is a per item cost. And so your per item cost is going to be usually called like an auth fee or auth and capture, which I'll talk more about that in a minute. And you put that together and that's going to be a per item cost. So it's going to say in addition to the interchange and card brand fees, we're going to also charge you 3 cents per transaction. And this Schedule A is from the sponsor bank, the acquirer. And so they're going to come together and say, here's our Schedule A. So they're looking at that and saying, we're going to take that first 3 cents per transaction. It's also usually going to have some basis points. So it'll have maybe like 2 or 3 basis points. Now, a basis point is another one of those core terms. A basis point is 1/100th of a percent. Okay? So 3 basis points on this would be like 3 cents and 3 basis points. So they look at each transaction that comes through and they say we're going to take the first 3 cents and the first 3 basis points. And there's also going to be some monthly cost. Now, this is where it can get crazy if you don't understand Schedule A's, so you got to watch out for this because you can have a lot of different monthly costs. You know, you could have a monthly on file fee, which is basically just saying in order to have a merchant account, it's going to be $4 a month. You could have a PCI cost of $5 a month, an IRS cost of $5 a month, all these other things, right? It can really add up. But a really competitive Schedule A should be in the range of $10 or less in total monthly cost, with like 3 basis points and 3 cents. And that's going to be that kind of industry standard core cost that's going to be added onto the interchange and card brand fees. So I just gave you a ton of information. We're going to talk about some other costs in the next video, but I want to end this one right here by going through this calculation one more time to make sure we're on the same page. So we have a merchant, they do $100,000 in processing volume. We put them on flat rate pricing of 2.5%. So we're collecting $2,500 in total fees, or what we call revenue or fees, right, collected. And out of that $2,500, we got to figure out what our costs are, our expenses, so we can see how much margin or profit is left. Well, first of all, we have interchange. We're saying that's going to be 2.1% for this restaurant. So that's $2,100. We have card brand fees and assessments, which we're saying is 20 basis points or 0.2%. So that's going to be another $200. So now we're at $2,300. Then we have these Schedule A costs. So we add another $10 of, just a monthly cost per merchant account. So now we're at $2,310. And then we have 3 cents per transaction and 3 basis points. Well, 3 basis points would be $30. So now we're at $2,340, doing this math in my head. Then we have the per item. Now, we didn't have the effective rate figured out here, so we don't know what that's going to be. But let's say that we end up, that's going to be another, let's say $20. So we're now at $2,360, right? That's our cost, all right, on this account, leaving us $140 in margin or profit. So watch through this a couple times. If some of this didn't make sense to you, make sure you understand that core logic, and then watch the next video I'm going to put out next week, where I'm going to explain a little bit more of the cost and start talking about the fee structure. This video was brought to you by ISOAMP, and guess what? In ISOAMP, we have an entire section to understand your residual or margin. So all these complicated terms I'm telling you, it's a little difficult when you're looking at a statement to eyeball it and say, well, I know what my margin is now. No, what you want to do is you want to load it into ISOAMP, let our system look through that, you do the pricing, and then let our system show you exactly how that margin is going to break down line by line. Head over to ISOAMP, it's GETISOAMP.com. Click on the free demo and check it out.